Hello, everybody. It's been a minute since I've posted a video. I figured I'd better do it. Summers get busy, but so hopefully this is a short video. Today I just wanted to discuss the risks associated with offshore accounts, meaning accounts in places outside of the U.S. And when I mean accounts, that could be bank accounts, checking accounts, credit card accounts, well, probably not credit card accounts, but any cash depository accounts, so savings account, investment accounts, checking accounts, or stock or bonds, or any sort of other investment that is uh, around cash or currency. That could also mean crypto, that are held in institutions outside of the US. So what I am not talking about is, let's say you have a Charles Schwab account or an E-Trade account or a Wells Fargo or whatever. Like, you're going through a US brokerage firm and you happen to have investments in stocks or companies that are outside of the US, so like Chinese companies, European companies, South American companies, stuff like that. That doesn't count because you are going through a US brokerage and you are getting a 1099 from a US brokerage reporting those things. So that does not count. That is not what I'm talking about. What I'm talking about would be you're going through a brokerage in Brazil or China or England or whatever, like the UK, right? Like, so if you have a brokerage account in another country that you're using to invest in, and what that could even mean is if you're going through a brokerage company in Spain and then happen to have stock through that brokerage company in a US firm, that like this applies as well, right? So that would still be considered an offshore account. Um, so that's basically the definition of an offshore account. It's investments or cash depositories in any financial institution, investment account, crypto account, wallet, whatever you want to call it, outside of the U.S. Okay, so that's what I'm defining as an offshore account. Uh, what is going on? So, back in the 80s, 90s, early 2000s, there's a lot of talk about how you can minimize your taxes by moving money to offshore accounts. Basically, you're hiding your income from the US government. Well, the US government, if you are a citizen or a resident and you're filing taxes in the US, you are taxed on worldwide income. That means that it doesn't matter where you earn it, you still owe taxes on it in the US. Then you get a credit for any taxes paid in other countries. So, like, Spain has a 40% tax bracket. If you're in the 40% tax bracket in Spain and you pay taxes on earnings there and then you report it in the US, you're not going to pay any taxes on it in the US for the most part because you've already paid the maximum amount of taxes. Now, if you're in another country where your tax bracket, let's say, is like 5% and you're in the 25% in the US, then you're going to owe additional taxes on it in the US for the full 25%. Now, that foreign taxes paid credit is not dollar for dollar. It is for lower tax brackets, and then it becomes like 80% on the dollar, or less as you get into higher tax brackets. So just keep that in mind too. So that's the law around this. You are required to pay taxes on worldwide income in the U.S. Okay, so that's the law. So what has happened is people are trying to shuffle money into offshore accounts to prevent paying taxes in the U.S. and they're putting them in accounts in countries where there aren't any taxes. So like the Bahamas or Panama is a place I've heard. There's a few others, like Switzerland. There's a few others, but in the about 2010 time frame, through different tax treaties and other venues, the federal government, the US federal government, has used the power of the dollar as the currency for international trade to force governments and private institutions to report um, anything to the federal Treasury Department if it looks like it's associated with a person in the United States. So basically, what does that mean? The big dog, Uncle Sam, is forcing Switzerland and businesses in Switzerland or the Bahamas to report uh, any accounts um, that have any link to a US citizen. So if you have a mailing address in the US, they see deposits coming from a US bank account, stuff like that. They're eventually going to report it to the US, and the US has been able to do this because they will penalize these institutions if they don't. So there is a reporting requirement to tell the IRS and the Treasury Department that you have these offshore bank accounts. Now, these offshore bank accounts may not mean you actually owe taxes. It is just telling the government that you have these accounts. It's an informational report to the IRS and the Treasury Department. No taxes due. Now, the problem is the penalty associated with failure to report. So not only are they penalizing foreign institutions for not reporting to them, they are also penalizing you for failure to report too. And this is a great example of the federal government using an axe to address issues instead of using a scalpel, meaning they go after individual people. They're just doing a blanket, we're destroying everything that we possibly can to scare people into compliance. And that's exactly what's happening. So if you fail to report your foreign accounts, which, as I said, it's voluntary reporting, or I guess it's not voluntary, it's required reporting, but it doesn't result in any taxes necessarily just because you report it. But if you fail to report, the penalty can be as much as 50% of the balance at any point in the time that you've owned the account. So what does that mean? Let's say, so this is I can't actually, I don't remember the actual court case, but I have read it. It's come up in continuing ed multiple times when we're talking about this situation. But there have been multiple, millionaires that have been hiding money in offshore accounts. They fail to report it. The IRS audits them, takes them to court. They fight them in court, and the IRS wins. And when they win, ultimately, these millionaires are forced to declare bankruptcy because at some point they had like $10 million in these offshore accounts. So that means their penalty could be as much as $5 million. And now there's like $500,000 in the bank account. So now they're declaring bankruptcy because they don't even have the cash available to pay the penalties. So I've actually had to deal with this with an actual client of mine. He came from New Zealand. He had no intentions of hiding anything. He was a foreigner in the US providing services to the dairy industry. He had been to Ireland. He was an engineer that had designed some special equipment to help with milking cows. And he designed it in New Zealand, sold it to New Zealand dairies, had gone to Ireland, sold it to Ireland dairies, and then he had come to the US and he was now selling it to US dairies. He'd been in the US long enough to be considered a resident, and it was also the best way for him to pay taxes. Well, the first CPA firm he had gone to failed to report his offshore accounts because he was in New Zealand here on a visa. So he had New Zealand accounts. He also had multiple European accounts because of his time in Ireland and other countries in Europe. And none of those foreign accounts had been reported to the IRS. We'd gone through a special program to remedy that, where we had voluntarily reported to the IRS instead of waiting for the IRS to get the information from these foreign institutions and then coming after him. It's not a matter of if, it's a matter of when it comes to these foreign financial institutions. The IRS will eventually come after you. So we did the voluntary reporting program. This was back in, I think, 2017, 2018 timeframe. I don't even know if this program's still available, but it was at the time. And basically, the voluntary reporting requirement limited the penalty to $10,000 per year per account. And it was, so we were looking at, I think, $200,000 in penalties by doing this, when the penalty could have been over $1 million. He didn't even have the cash to pay it at the time. We literally advised him it might be best if you leave the US, go back to New Zealand, and don't come back. Uh, that was one of the options that he had. He actually, in the long run, he decided to just start making payments on it, do a payment plan, merely because his ability to make for earnings in the U.S. was much greater than that penalty. So he decided to pay it. He paid it over the long run and was able to stay in the U.S. and continue to run businesses here. So this is just, this is kind of a, hey, I don't even know, like in all my emails I send to all my clients at the beginning of tax season, I say, hey, if you have any foreign investments or bank accounts, let me know, because I do not know unless you tell me. So, and that can change from year to year. I don't know what somebody does, between years. There's a lot of stuff that can happen in a year, that unless you send it to us, we have no idea. So if you have a foreign bank account or foreign investments or investments through a foreign brokerage, you need to tell your CPA at tax time so that they can make sure to report it. It's not going to shouldn't result in any additional taxes. If it does, it's not going to be any greater than your current tax rate in the US. And it's only going to be taxable income. So like if you're getting interest on it or something, the cash in an account doesn't necessarily result in taxes. It's if you're getting interest on it and then you pay taxes on that interest. So just keep that all in mind. It is definitely easier on you to report it than to not and get penalized. I guess the final thing I'll say is there is a threshold. The government does understand that, chump change isn't worth fighting, and it's $10,000 in aggregate. So what does that mean? If you have $10,000 or greater in any or multiple investment accounts outside of the US, then you're required to report all your accounts. If all your accounts accumulative, meaning added up, is less than $10,000, then you don't have to report. Now that might mean, and that's greatest value throughout the year. So let's say you have 5 accounts, and in each account you have, $100. Well, that's only $500, and that was the greatest value you had in the account throughout the entire year. There's no reporting requirement. If you have 5 accounts and one of them, let's say, is greater than $10,000 and the rest only had $10 in them throughout the year, then you are required to report because you had accumulatively more than $10,000 in accounts. So that's the rule, the thresholds there for reporting. Anyway, I hope this is helpful and helps you better understand why it's necessary to report it. Mainly it's because the penalty is so much greater than the desire to not report it. Anyway, till next time, thank you. Bye.